Let's start with the question number 3 because this is the most important question I think in this exam, right? Let's read the question first. Following a series of discussions, here I have make this question in a little bit strategically. Therefore, all the information available here. A series of discussion with the shareholders of WA Pharmacy Private Limited, HSPLC. Management has resolved to proceed with an investment in WA as an equity partner. In parallel, in order to secure a stable and predictable return, HSPLC has also decided to invest in 10% redeemable debentures of WA. That means they have decided to invest in both equity share and debt capital, which will redeem at the end of a 3-year agreement entered into with the shareholders of WA. HHPLC will invest in WA as follows. They invest in both debt and equity. In debt investment, 10% redeemable debentures, redeemable after 3 years, amounting rupees 100 million, to be made in 1st April 2025. Face value 1000 per debenture and will be issued at 10% discount. In addition to that, investment of 300 million in ordinary shares of WA, resulting in an equity stake of 45% to be made in 1st April 2025. Both are in the next day. Then we are at the 31st March 2025. All the investment will be made on 1st April 2025. Both the entities management are of the view that the financial and operational forecast presented for the next 3 these two capital infusions. This dual structured investment support HSPLC backward integration strategy by strengthening control of critical stages of the pharmaceutical supply chain. In addition to ensuring a sustainable supply of high quality product with reliable and timely availability, the strategy is expected to enhance cost efficiencies, improve margin stability, reduce dependency on external supplies. These are the plus points of having a pharmacy under this hospital, right? SS Pharma is considered a benchmark company in Sri Lanka pharmaceutical industry, indicating that it is a leading company and key reference point within the sector. Often used as a proxy of obtaining relevant data. That SS Pharma is a listed company similar to this WA company. The company capital structure debt to equity ratio is 30% with a beta value of 0.4. Government treasury bill rate is 7.5 and the corporate income tax rate is 30%. Then they have mentioned some additional information about the pharmaceutical market in Sri Lanka, right? And the pharmaceutical market issues, what they are facing, what are the issues in the market, everything given in the next introduction, right? Then the first thing, evaluate the yield to maturity of the debentures proposed to be issued by WA to HHPLC, because the HHPLC going to invest in WA in preference share and ordinary share. Therefore, ordinary share and preference share, debenture and ordinary shares, right? Issuer will be WA, right? Therefore, you have to evaluate the yield to maturity of these debentures going to be issued by WA to HHPLC and explain the strategic and financial advantages from WA's perspective of raising funds through debentures as opposed to issuing additional ordinary share capital. Now, WA going to issue debentures. What are the benefits of having debentures against the issue of ordinary shares? That is, you have in your chapter, I can't remember the exactly chapter, equity capital. There is a chapter called equity capital. In that chapter, you have advantages of having equity shares. Again, you have a debt capital chapter in your study text. You have advantages of issuing debt capital against the equity capital. Those things, this is reminding you to go through those things again and again and understand properly what are the advantages of having debt capital against equity capital. Not only that, advantages of having equity capital against the debt capital as well. Both you have to remind, right? Now here they are asking you to calculate the yield to maturity of the bond, right? You know, yield to maturity is the expected rate of return of the bond. That's called yield to maturity. Required rate of return, it is simply the IRR of the cash flow of the bond, right? Simply yield to maturity is the IRR of the cash flows of the bond. As per the information of this bond, it is 3-year bond, right? Here, information given, it is 3-year bond, 10% per annum, issued at 10% discount, value is 100 million. Going to the calculation, question 1 point, yeah, question 1, yield to maturity of debentures. You know the years, it has only year 0, then year 1 to 3, sorry, and the third year. At year 0, what are the cash flows? From the investor's perspective, you can say year 0, you will issue the bond, the 100 million worth bonds or debentures issued at a 10% discount. Then you get only 92% of this 100 million, right? As a cash inflow, you get only 92% of the cash flows. I am making the calculation from investor's perspective, then it is easy to calculate IRR, right? Even in the issuer perspective or investor perspective, no issue. But based on the practice we have in IRR calculation, better take it as investor perspective, right? Or or you can go with the other perspective, that is issuer perspective. If it is from the issuer perspective, 92 is a inflow. From the investor perspective, 92 is a outflow, right? That you have to keep in your mind. Now, issuer get cash at year 0, then pay interest and the principal at the end of the third year. Investor pay cash at the year 0 and receive interest and principal at the end of the third year. Now, for the easy of calculation, better consider as a issuer, then it will help you to easily calculate IRR, right? Now, 10% means 100 million into 10%, right? Again, you have to remove the tax impact, 1 minus 3, that is 0.3, right? Then I think you can understand the formula I have made, 100 million into 1%, right? Then 1 minus t is the removing of the tax implication, right? Tax rate is 30%. Then end of the third year, they pay you the 1,000, the face value, 1,000 into, yeah, that is you are getting 100 million rupees. Yeah, we are getting the total value. Therefore, 100 you are getting at the third year. Now you have to get the 2 discount rate. Let's take discount rate as 10%. And you know this is 1. Then here you have to take the accumulated discounting factor. Lasisa, just tell text in the chat whether that discounting factor is correct, right? Lasita, I got it 2.48. Here I got the investor's perspective, that is the person who invests money. That's why I got year 0 minus, right? What you have to do, you have to change the other way now. If you want to take the issuer perspective, you are getting money at the beginning, then you are pay interest annually, and you pay principal at the end of the third year, right? Whatever. Okay, Lasha, tell me whether this discount factor is correct because I use Lasha, whether tell me whether this discount effect is correct, right? With the calculator. Right. Then third year discounting factor here, 1 divided by 1.1 power 3. Now you can get the present value. You can get the total also. It is minus. Then let's take discounting factor. Now we need a plus answer, right? Let's take 8%. At 8%, happen at minus. Yeah, we have to get a higher one because we are using the other way around. Let's take 15%. If it is 15% here, it should be 15%. Right. Now I will show you a small theory here, right? Because this is not the way we calculated in normally in IRR because we are using the issuer's perspective, right? When you make it issuer's perspective, you need to understand how IRR works. Okay, I will show you how IRR works. Now see, here let's say this is 0, right? This line shows rate. This line shows no, this line shows NPV, and this is shows the rate, right? Now see at 10%, let's take 10% here in 10%. Here 10%, 20%. Better take it as 5% wise, right? 5%, 10%, 15%, right? NPV, let's take 2 by 2, 2, 2, 2, 2. Now it's take one line 2. Let's take this one line shows 2, then 4, 6, 7, 8, likewise. Okay. Now at 10% minus 1. right? Then let's take here 1 minus 1. Now at 10% minus 1 is, this is the point. The cursor you can see, that is the point minus 1, right? 10, if you take 15%, at 15% plus 10, 1, 2, 3, 4, 5, 6, 8, 9, 10. It just like here, right? Approximately I'm getting, right? We have to have another 2 lines. Let's take, then exactly it's correct. Let's take here 10. At 15%, 10 will come here. This is the point. Now you have to join these two, right? This point and this point. I will insert a line and I will show you. This start from here, right? It goes to this point, right? Now, the traditional way of using the formula will little bit change, because this is the borrower's perspective from the issuer, borrower, same, right? Issuer perspective or borrower perspective. You can see IRR comes here, somewhere here, where this blue line cross the red line, right? IRR comes here. It is more than 10%, right? Now 10% gives you the minus answer, but don't think about the formula. It should be more than 10%. Therefore, you can write down formula as 10% plus. It should be more than that. Then let's see how we calculate the balance. It is below 15%, but above 10%. Now you need to see how much the difference from this 10% to here, right? But when 10% to 15%, total change was minus 1 to 11, right? But you want to take the difference till minus 1 to 0. Therefore, you will take minus answer as the numerator, divide by both minus and the total distance, that is 11, right? Multiplied by difference of the rate. I think you can understand what I have did. This is the real formula for IRR calculation. This will be a little bit confusing you, because you have practiced to do the other way, investor's perspective, and you keep your mind one formula in your mindset, right? Plus answer rate plus, likewise. Don't practice like this, right? It should be more than 10%. That's why I took more than 10%, 10% plus, right? It should be between 10 and 15. That's why multiplied by 5 difference. You need how much the rate, how much the amount changed from 1 minus 1 to 0, that is 1, out of the total, that is 11. 11 changed because of the 5% change, therefore how much for 1 change, right? 11 million or whatever change because of 5% change, therefore how much for 1 change? 1 is minus 1 to 0, right? Now you can calculate the IRR. I will put them into the formula. 10% plus 1 divided by 11 multiplied by 0.05. It is approximately 10.5. Is that correct, Lasita? Did you calculate it? Lasita, can you text me? Is that 10.5? 10.45, you can take it as 10.5. Yeah, thank you. Right? You can take at this as 10.5 as a percentage with decimal places. Yeah, take 10.5. This is IRR. You can say this is yield to maturity as well. Now, if you take other way around, that is investor perspective, this will be minus, these two numbers will plus. Then this curve going here to here. Always you have to take the rate before the crossing point, right? Rate before the crossing point plus the value difference until the zero divided by total value difference multiplied by the difference between the rates. That is the theory of IRR. Therefore, yield to maturity of this bond will be 10.5. That is cost of this bond. You can take it as 10.5, right? You can ask any question if you have before moving to the next question. There are 12 chats. Let's see what is this. Oh, there is a calculation error. Let's see what was happened. Here, I took total value, right? Rupees billion, rupees million. I think I am correct. Let's see. 100 million total value issued at 8% discount, therefore 92 million. Then 10% means on 100 million, 10 million, right? Out of 10 million, once you pay tax, it is 7 million and redemption at 100 million. I took total value. Or you can take uh, per value, that is per bond. If you take per bond, it is 1000, then 92% means 920. I will change the numbers and show you. 920 per bond, right? Then it is not rupees million per bond. 920, then it is 10% means 100, but you are getting only 70, right? After tax. And you get the 1000 end of the day, right? Then these are the numbers. Then you can put these numbers. These are plus, sorry. This is plus for the borrower. These are minus for the borrower, right? Then it's come like this. Once it come like this, you have to put those numbers here, right? 10% plus 5 divided by 108, right? 5 divided by 108, right? Almost 10 amount is coming. 5 divided by 108, right? Yeah. 5 plus 103, 108. Yeah. If you take bond wise, this is the way you have to take it, right? But I have calculated based on the total value of the bond. No issue, right? Let's see any questions you have. Sir, is bond interest liable to tax? Yes. Any interest income liable for tax? Any interest income liable for tax in Sri Lanka? If it is wrong, take 10 instead of 7 years. You can take 10 if there is no tax in the country. But in Sri Lanka, there is tax. Okay. Now we are moving into the next question. Question 2 is the critical question here. Estimate the impact of share price of WA, that is the pharmaceutical company we are going to invest, based on discounted cash flow method before and after the proposal capital infusion, on the assumption that WA is able to improve its operational efficiency and overall financial performance by 25% following the capital injection. After this capital injection, right, 25% increase is there. That means without this capital injection, there is no 25% increase. If you go to the annexures in this question, you have WA P&L, WA balance sheets. Then this number 3, WA has been estimated the next 3-year performance assuming new funds has been deployed. Look here, assuming new fund has been deployed and necessary technological enhancement have taken place. Therefore, this table given Actually, this called first money. Cash flows has been estimated. Not cash flows, EBITDA, depreciation, working capital changes, and capital expenditure has been estimated. First money. That means once that main company invested in debentures and shares, that they told their investment will, sorry, return will increase by 25%. After increase by 25%, this is the result. Therefore, this we can call is first money result is given. But examiner asks us to calculate the share price impact. Therefore, you have to calculate before what will be the share price before infusing the cash flows, and after infusing the cash flows, what will be the result in share price. That means you have to do two share valuations, right? This cash flow, you have to use discounted cash flow. Therefore, this EBITDA and information you can use, but this table can be used to calculate the share price after infusion, because this has estimated after infusion. If you want to calculate before infusion share price, you have to adjust these cash flows and go back, because this is after increase of 25%. That means here you have 125. You have to remove that increase 25 and take the normal information before the infusion and do the valuation for pre-cash. Therefore, here simply you have to value the company pre-cash and post-cash, right? Is there any question about this explanation? Please text me, then I can answer you, right? The examiner gave you the cash flows, sorry, EBITDA and other information, which can be derived after infusing this additional capital and technological enhancement, right? But now in this question, they ask us to calculate the share price before the infusion and after the infusion, right? The theory behind this is, I will write down here, right? Theory behind this is question 2, right? Post money cash flow estimation has to be discounted by post money WACC, because post money means after introducing the cash flows, that is additional capital. After infusion additional capital, you have estimated your cash flow detail, that has to be discounted by post money WACC. That means after infusing this debenture and share capital, your WACC will change, because your capital structure will change, right? Therefore, WACC will change. You have to calculate the new WACC after infusion capital. Cash flows are there. You have to discount and see the share price. As well as you have to do this for the before infusion, right? Before infusion data available in the balance sheet, what is the debt equity ratio? You have to calculate the WACC for that as well. And you have to re-estimate the cash flows before infusion of the capital, right? I think is that clear? Is that clear? Any questions about this before moving to the calculations? Kushan, are you okay? Kushan, can you text me and tell me whether you are okay? All right. Okay. Let's go to the calculation now. Now we have to write down these numbers here, and we have to calculate the WACC as well. Let's first calculate the WACC, right? Before calculate the WACC, better we prepare the capital structure. This is their balance sheet before infusing this additional capital. They have equity 296, right? They have equity 296. Can see here. They have debt here 101, that is loans, and here they have Term loan 21. Right. Now, this is the existing debt to equity ratio. We need existing one also. Therefore, let's calculate debt to equity ratio before and after. Right. What are the items included? Equity, then loans and debenture. Now, equity they have 296, I think, yeah. 296 before. Loans they have 101 plus 21, 122, and debenture they are going to issue how much? How much we calculated at discount? 92 million, right? Debenture 92 million because they are going to collect 100 million, but there is a 8% discount at the issue. Therefore, their debt is 92 million here is cash coming to the business. Is that correct, Lasita? Is that clear? Lasita? Right. Now, this 92 million is a after story, right? Sorry. 92 million not before, it is after. Loans will remain even after. This is this plus they are going to issue 300 million ordinary share also. Now, this is the capital structure, right? Before and after. Now, you can see capital structure before and after. Let's take the total as well. Here, debt, equity, and loans only. But here, additional equity of 300 million came, loans remain, and debenture also came. This is the capital structure. Now we have to calculate the cost of each category, right? Let's calculate the cost of capital after and after as well as before. Let's go with before. Before the issue, to calculate cost of equity, we can use CAPM model, right? As per the CAPM model, you know risk-free rate plus into risk premium to beta. Now you need to calculate beta, right? Uh, I will just type the beta formula here. You know, you have to write it down at the exam. You have been given a similar company data to calculate the beta. Here, their debt to equity ratio was 30% and beta was 40%, right? Now, you know, asset beta asset equal beta equity multiplied by, right, equity divided by equity plus debt into 1 minus t. This is the formula, right? Now, to calculate the asset beta of the industry, we can formulate this thing. Equity beta 0.4 of this new selected company multiplied by, right, debt to equity is 30%. That means you can take as 70% as the equity divide by 70 plus 30 multiplied by 1 minus zero point 0.3, that is a tax rate. What happened? Is that correct? No, this has to be one formula. Is this number correct? Please tell me, Lasita. 0.31. Lasita? Okay. There is a question, sir. Can we take lease liability as a part of debt? No. Lease liability, deferred tax, those are accounting treatment which we are using in accounting, right? Lease liability is not a real liability. It is the present value of future rental payable, right? As per the IFRS 16. Therefore, it is not a real liability to be paid to a bank. It is the present value of future lease commitments. That's all. I think it's clear, right? Uh, right. Now we got the asset beta like this. Now we can calculate equity beta. The equity beta formula means you have to put the numbers into this formula, right? To calculate the equity beta, you have to use asset beta. Then take this entire formula and divide the asset beta. Then you are getting equity beta. Sorry. This process we call gearing, ungearing, right? Now, now you have to re-gear with your company data. Re-gear with WA debt to equity, right? Okay, let's re-gear it. The formula will be beta equity equal beta asset divided by this part, right? Beta asset divided by this part. Sorry. This asset beta we already calculated, therefore we can put them into the formula. This number 0.31, let's take 31, divide by, right? Divide by, I will take, sorry, I will make it easy for me for the calculation, right? Don't upset that. I will take this part and I can put the numbers easily here. So I take you have to make here divide of asset beta, it is 0.31. Again, it's become 4. This is the asset beta for WA. Sorry, equity beta of WA after regear, after regearing, right? Now you can put them into equity, that capital asset pricing model. Therefore, cost of equity equal, right? Risk-free rate was 7.5. Here I have taken market return as 17%, but if it is in the exam, you will be given different rate, right? Don't worry. That's based on the examiner's requirement. Then 17% minus 7.5 into beta, right? Multiplied by 0.403. That's the beta. Let's calculate it. 7.5 plus 9.5. 9.5% into 0.403. Is that correct? 7.5. Is that formula correct? Higher percentage has to be added. Don't worry because I'm using the Excel and I'm making some mistake. Don't worry about that, right? Therefore, cost of equity become 11.33. Now you have cost of equity, cost of debt. It has to be taken as the 10%. I think I have mentioned here, right? As I mentioned in the question. Yeah, it has to be 10% borrowing cost. But again, examiner will give you, right, cost of debt, right, equal borrowing rate into 1 minus t. ලසිත මේ මාව ඇහෙනවද දැන්? මම ඩිස්කනෙක්ට් වුණා සිග්නල් අවුලක් ගිහින්. Can you hear me clearly? Is that
Yes,
clear?
we can hear you. Yes, we can hear you.
Okay. If there is any issue, tell me. I have some issues in this is with the climate. Okay, there is a question raised. I think there is a question raised. Sir, this is re-gearing process. We have to use WA debt to equity or benchmark. In gearing, yeah, in re-gearing, we have to use W A debt to equity. Here we have to change it, right? Actually, I have mistakenly taken the same formula, copy and paste. In re-gearing matter, we have to use this. Now we are calculating uh, the same thing because we are calculating equity beta for WA, right? We are calculating equity beta for WA. Therefore, in re-gearing, we have to use WA debt to equity. Sorry, because I have not changed that while I'm copying and paste. I missed, forgot to do that. Now we have to use this before one, right? Now when I goes to here, we have to put here, they have equity 296, right? Sorry, while copying and paste, these mistakes happen. Very sorry for that. And 122, not big change, I think. And then it's become 3.9. 4. Again, same 4. 3.99. We can take it as 4. Then here you put it as 4, right? Then it's become exactly 11.3. 3.99 means you can take 4, right? 11.3. I think that's clear. I think your problem is okay, right? The student Udar. Can't you see my screen? I think you can see my screen, right? I have shared it. Okay. Now, cost of debt, we have to take 10%, right? Into 1 minus 0.3. This is the cost of debt. Now you can calculate WACC. WACC equal, directly I will apply the formula, cost of equity into, sorry, cost of equity into percentage of cost of equity, right? I will quickly take the percentage here. This divide by total and this divide by total to get the percentage, right? I can easily do because I'm on the, then I can take equity percentage 71%, right? You can see here 71% multiplied by 11.3%, right? Then plus 29% debt percentage multiplied by 7%. Then this should be the WACC formula. Put it into and tell me how much the WACC. Rasida, can you tell me how much the WACC once you put them into the formula? Please tell me the answer. When you put these numbers into formula, what is the answer? Tell me. 10.1 or 10.05, right? You can take 10.05 as the WACC. Tell me whether it is correct. Is this correct? This is the WACC. Now this is the WACC before additional share capital, right? This is the WACC before additional share capital. Then 10.05, we have to discount the adjusted cash flows because I will take down it further here. Now cash flows, right? They have given for 3 years, right? 1, 2, 3, right? They have gave you EBIT, right? Then you have to add depreciation. You have to minus capex, right? And you have to minus working capital changes. And you have to take the tax as well. These things you have to take. Now EBIT, earning before interest and tax, they have given. Let's take the numbers quickly. 30, 35, 40. 30, 35, 40. Then they gave you depreciation 568, right? 568. Then they gave you capex -5, right? Then they have gave you working capital changes 10, 12, 15. 10, 12, and 15. Now we have to calculate the tax, right? Earning before interest and tax. Now how to calculate the tax? This is earning before, since this is earning before interest and tax, right? You have to make an assumption that depreciation and the capital allowances are same, right? You have to make that assumption. Let's calculate tax. The assumptions you have to write down. EBIT is there. Let's take EBIT as it is. Then you have to reduce depreciation. Then you have to reduce interest. You are calculating the taxable profit. Interest. Interest is very simple. You have 122. I think 122 is the debt now. Yeah, 122 is the debt. 122 is the debt into 10%, right? Interest. Now you have accounting profit here. Accounting profit. You don't want to do these long calculations, right? There are shortcut methods. But since you are asking question, I'm doing these long calculations, right? Then again, to convert into account a taxable profit, you have to add depreciation, right? You have to add depreciation like this and deduct capital allowances, right? And you have to make a assumption both are same, right? You have to make assumption capital allowances are both are same, or otherwise exam will give you capital allowances, right? Taxable profit. No need to do this long calculation, but for your understanding, I'm telling, right? Then tax at 30%. Then you can put tax here. Now you can take total cash flows. Then you are required to calculate terminal value. Right, you have to give the terminal value. That is, you have to take the third year cash flow into 1 plus G divided by WACC minus G. Now the problem is, what is the growth rate, right? There are some information in the market detail about the growth rate of the industry. I think so. Let's see. According to the Statista, Sri Lankan pharmaceutical market is expected to record steady growth, with industry revenue projected to reach approximately 274.22 and by 2025 and 296 in 2030, representing a compound annual growth of 1.55. Right now, there is a 1.55 growth rate. Then you can do this, right? This cash flow multiplied by 1 plus 1.55%, then close the bracket, divide by, right? WACC how much? This is the WACC minus growth rate 1.55. Then this will be the, you can see the formula here in the taskbar, right? Third year cash flow 222 into 1 plus growth rate, that total divide by WACC minus growth rate. Now we have the total, right? You can take the total here and discount by the WACC. Here you have WACC 1 divided by this, 1 divided by 1 plus this, sorry. Then here this divide by 1 plus this. I think these are simple calculations for you. Now you can take the present value. Then enterprise value, we call this enterprise value, right? That is free cash flows to firm here. Free cash flows to firm discounted by WACC, that is enterprise value. And it's become 266, right? Then you have debt, you need to deduct it. You have debt 122, you have to deduct it, right? Then you have cash balance to add. Any short-term investment you have not considered in the valuation also you have to add. Cash and cash equivalent. Let's see how much in the balance sheet. They have a cash balance of 82 and overdraft balance of 85, then minus 3, right? Cash balance of 82, overdraft balance of 85, therefore minus 3 is there, right? No other short-term investments, therefore you can take minus 3 here as cash. And your business value of equity, you can divide this by number of shares to get the share price. This is the value of equity before infusion. Now the problem is this part. Now look these numbers. I will show you how it changed. These numbers are not correct. I will tell you. This is the lesson. That's why this question I have included in the paper also. These numbers I will put it in red color because I want to tell you the issue now. Look here, this WACC. The WACC we use before capital infusion. But these cash flows given after capital infusion. And they have told the cash flows will be increased by 25% after capital infusion. Therefore, what you have to do, all these numbers you have to take here after removing that 25% increase. Right? Therefore, you can't take this answer as the correct because these are forced money cash flows. WACC is pre-money WACC. That is the theory you have to learn. Therefore, you have to remove this 25% increase from here. How we can remove? Very simple. You can divide this by 125 and multiply it by 100. That you have to apply. Right? I will quickly change that numbers. I think you can understand what you have to do. I will first change and this come to your chat. Then I can answer your questions, right? We are removing this impact of 25% increase. Depreciation also same because additional capex came, right? We can assume same increase is there, right? Now we have to remove this additional capex thing. Then it is become like this. Then capex, if there is no capital infusion, there is no capex, right? That is the other point you have to take, right? If there is no capital infusion, there is no capex. Okay. Then working capital changes you have to change because this is with the capital infusion. You have to take before capital infusion. Now tax also, you have to change those things. Yeah, it has been automatically changed. EBITDA. Then simply before capital infusion, your total equity value become 150 million. 149.64 means 150 million. This would be the way. That means you have to recalculate the EBITDA and related information how it would like before the capital infusion. That means you have to remove that 25% increase. Now just I have removed it, right? Now if you have any question you can ask now. I can answer. When leasing right of use asset and a lease liability is not an obligation or financing source you have taken. Therefore, lease liability is not part of the financing. Keep it in your mind. It is an accounting entry only. Financing means from you have borrowed or you have taken funds from outside to run the business. Here you have not financed. You have only agreed to pay rental monthly or annually. As an accounting treatment, we have taken into the books based on an accounting treatment. Therefore, lease liability is not a part of debt, right? So when arriving earning before interest tax, depreciation has been deducted, isn't it? Then why again depreciation reduced in EBIT? Yeah. EBIT is calculated how they are. Yeah, that's correct, Pudha. That is okay. Let's correct it. EBIT, yeah. EBIT, therefore here depreciation deducted, that's why we have to add back. But when it's come to the EBID means depreciation is deducted. Yes. That's why you have to add back depreciation and deduct capital allowance. Yes, that's correct. I think that is correct. You don't want to deduct depreciation because it is already deducted from here. Since it is here deducted, you have to add back because it is not a cash outflow, right? Capex I have removed because this is before capital infusion and no capex. Is that clear, Ashed? Okay. Yes, please show the task computation. Here I have, yeah, you can see the task computation. Now same thing you have to do for the post money. In first money, very simple because you can take same numbers, but you have to calculate the WACC, right? You have to calculate WACC for after money. WACC you have to calculate. Therefore, first of all, let's calculate capital structure, right? Let's calculate capital structure in as a percentage. It is easy then. Yeah. Now you already calculate cost of debenture. That is IRR we calculated. Loans you can take 0.7, but you have to calculate this cost of equity will change because their gearing has changed. You can see their gearing has changed. Therefore, these numbers has to be calculate again. Therefore, I will copy paste this part. Once I copy paste, I think I can, yeah. Now cost of capital after the issue. Let's say after. I am changing, then you can easily take it, right? I will explain and do it. If there is any mistake, please tell me, right? Ungearing is correct, same thing. Then regearing, right? You have to take the new capital structure. They have debt 73. Here, let's take 74. If it is 74, this should be how much? 16. 1511. 26. Yeah. 74 and 26 we can take after capital infusion, right? Therefore, in regearing, you have to introduce that part or the total value you can put whatever because percentage will represent there. Here I will put total number. How much the equity? 596. How much the debt? 122 plus 92. Here then 4, 1, 2, 214. I think it's correct, right? 214. 214, yeah. Then this is the asset equity beta, right? Then let's put this into the formula. 3.939. Let's take 39. Then let's take 39 here also. Then 11.21. It's 11.21. This won't change. Now we can go for the WACC computation, right? WACC computation, see, equity, loan, then you have debenture also. Therefore, this will further increase, right? Further increase by debenture, right? Let's see. Debenture percentage is 11, 15, 74. Debenture percentage is 11. Debenture cost is how much we calculated IRR. We calculated IRR as 10.5. Cost of debenture 10.5. Now this part is correct. Here, this is loan percentage become 15% within the formula. Then this is 74. Equity percentage goes up to 74. Cost was 11 point. How much we calculated cost of equity? 11.21. Right? This became 11.21. Okay, now this is the formula. See whether it is correct. We calculated equity increase up to 596. Therefore, their percentage is 76, right? Here, 74, sorry. 74%. Then loan percentage goes to 15% and bond issue there, bond percentage comes to 11%. We newly calculated cost of equity 11.21. Cost of debt won't change, but in some time in exam, they can be told you because of the additional debenture issue, there is an additional finance risk. Therefore, banks want to have additional rate. Hence, after capital infusion, cost of debt can be increased more than 10%. You have to be careful with that, right? Because when the debenture issue, there is an additional finance risk. But somebody can argue because of the equity issue also, they are doing a 300 million equity issue. This risk will be offset, right? Therefore, very careful when you read the question at the exam. Okay, now when you put these numbers into the formula, I will put it into the numbers into the formula. They are 21, 21 percentage goes to 74%. Then this is goes to 15%. And there is another debenture that is 11% into how much? 10.5%. 05, sorry, 10.05%. Then WACC become 10.45. 10.05, I think it's 10.5, right? Yield to maturity 10.5, sorry. This has to be changed, 10.5. Here also 10.5. Then WACC become 10 point. Here see WACC is 10.05. Have we taken WACC correctly here? Yeah. Here 10.05 before infusion. Now WACC is 10.5. Right? I will take the same cash flow statement for do the valuation. Then I can quickly do that. And I remove these things. 30, 35, 40. 30, 45, sorry, 35, 40. Then depreciation came how much? 5, 6, 8. Yeah. 5, 6, 8. I am taking now exact cash flows given. CapEx become -5 because they told you they have estimated their working capital changes how much? Even 10, 12, 15. 10, 12, 15. Tax automatically calculating here, yes. Then we have to take this one. Interest will change, right? Because this interest only not for this. There's another interest. What is it? You have to pay every year on the debenture, right? 100 million means every year you have to pay 10 million interest. I think is that clear, right? 10 million because this is the original bank loan interest. This is the debenture interest. Both comes here. That is one. Then WAC will change. Here WAC has to be changed. This would be the new WAC. New WAC will be 10.05. That's connected. 10.05. Now here debt. Further you have to reduce 92 million, right? Cash balance will remain as it is and value become 25 million, right? Now here the valuation technique and the WAC calculation is easy for you. The theory you have to learn. Now, if this hospital going to acquire or buy some part of the pharmaceutical company, they will invest in ordinary share or debenture or combination, sometimes in preference share. It can be a combination. That means after this additional capital infusion, they can that pharmacy will have a new capital structure, new debt to equity ratio. Therefore, their beta will change. Whatever the asset beta you have taken from the industry after ungearing will change with this new capital structure. Not only that, right? Then WAC calculation also impact with this new capital structure. In this paper, examiner gave you the cash flows can be generated after the infusion. Therefore, you can discount after calculating the WAC. You have to be careful when calculating the WAC. Now you can ask any questions you have. Working capital recovery will be considered in a project appraisal. Here we will take the terminal value. Therefore, no need to take that. As I did the mistake in depreciation deduction here also. No, I have removed it. Yeah, EBIT depreciation deducted. Then I have deducted interest with the new debenture interest also here, right? Then accounting profit. Then I am adding back depreciation because this is a tax computation and deducting capital allowance. This is both same because I have assumed capital allowances and depreciation are equal. That's the only thing I did, right? Is that clear, Chintaka? Chintaka? So when calculating share price of the company before capital infusion, why interest cost is not adjusted for? You are asking Hansini. You are asking about the debenture. You don't want to take the debenture when you calculate in the WAC or whatever before the capital infusion. Before the capital infusion, you have to calculate the WAC for the loan interest I have taken, I think. Here, this is interest. I have deducted in tax computation. 122, I think, is the total loan, not 125. right? 122 into 10%. I have taken. Is that clear, Anthony? Again, I am telling you, lease liability is not a liability or not a financial source, financing source. Now, this is the third time I'm explaining, right? Lease liability is not a financing source, it is an accounting entry only, right? As per the IFRS 16, when you identify the right of use asset, since you wanted to bring the asset you actually using into the balance sheet, it is an accounting entry where the finance lease liability comes. Got it? Therefore, it is not a financing source, right? What is the effect of 300 million share capital is calculated here because we took the equity as 596. Look here, 296 with 300 is become 596. 122 loan remain 122 and debenture also came. This is the new capital structure. That's why I'm telling you. After this is the new capital structure. You want to calculate back for this. This is before capital structure. When you cost of capital calculation for before, you have to take this. Cost of capital calculation of after, you have to take this. Right? Here, this is the confusion. That's why I put this question. This type of question has been tested twice in ACC also. Right? Before capital infusion, what is the share price? After the capital infusion, what is the share price? Right? Examiner gave you the cash flows after capital infusion. Therefore, you have to get the WACC for after capital infusion to estimate the share price after capital infusion. But if you want to calculate the share price before capital infusion, that cash flows has to be readjusted by removing the incremental part. Right? By removing the incremental part, you have to remove that part. And you have to calculate WACC for the existing balance sheet without capital infusion. But don't worry, this question cannot be tested as it is. I am trying to give you idea how to apply this knowledge. Lasita, is that correct? Lasita? Please text me. Okay, then we can move into the next question. Okay. Now next question. We will these answers with you. Don't worry. You don't want to write it down. Next question ask, discuss the strategic significance of the company decisions to invest in WA through a combination of debt and equity instrument without obtaining a control stake. Because they are going to have only 45% of the shares. They are not getting the control stake. And they are put the balance money as debt, not equity. They are not going to have the control of the pharmacy. They are going to have only investment in the pharmacy. Right? Both debt and equity without control. What are the governance, risk sharing, influence, and long-term partnership alignments, implications of this decision? Right? I have put the answer into this Excel sheet. You can, once I share this, you can read and understand. Here, one by one, I have included this. Right? Strategic rationale for mixed debt equity investment without not putting only in equity. Combining debt and equity allow the investor to deploy capital in a structural manner. Debt providing predictable return, very strong continuous return you are getting every year through debt, and downside protection. If there is a loss, even you are getting return for debt. While equity offers upside potential. If there is a higher profit, equity will give you higher return. Therefore, you have a balance of the investment. Then optionality. Equity provides exposure to the future growth, while debt can often be structured with conversion, redemption, or priority repayment feature, enabling flexibility as the relationship involves. Then this structure is particularly useful when entering a new sector, geography, or business model without committing to full ownership. Yes, you know, you are this first time you are going for the pharmacies, right? Therefore, better you put the head to the industry and understand it. Thereafter, in subsequently, you can go for the acquisition. Now, here there is no acquisition. Governance implications. Without a controlling stake, the investor does not consolidate the entity or control day-to-day operations. You don't want to bother about the consolidated financial statements. You don't want to console line by line here, right? Despite minority ownership, the investor may secure influence through. Then board representation now. This has to be in one line, right? Because I copy and paste from the word to here. Now, board representation, no observer, right? You don't want to control, but you can go to the board and observe what is going to happen in the business. You don't want to involve thoroughly in the business operations or finance decision, but you can be on the board because you have 45%, and you can see every day what is happening in the business and what is happening to your investment, right? Reserve matters, veto right or major decisions such as capital structure. You know, you have 45%. Therefore, for special resolutions, they need your consent also because they need 75% of the voting rights. Then information and reporting rights. You can get information. You can get the finances anytime since you have 45%, but you don't want to involve in operations, right? Then risk sharing, downside protections, everything I have explained here. I'm not going to read these things for you. You can read it, right? But I think if examiner going to test this type of thing, definitely this can be tested because most probably in the 50 marks question, there may be some 10 to 15 or sometimes in 30 of, sorry, 20 out of 50, 20 may be tested through qualitative questions, right? That's why you want this type of thinking ability, right? What are the benefits we have in investing an entity without getting control, right? That, you know, step acquisition is a strategy to understand the business and industry and get the control later on. Even here they are trying to do the same thing, trying to get into the industry through this pharmacy company and understand the business, work 2 3 years or 5 years with them, right? Be on the board without controlling, without influencing. You will see what is going on, then you learn everything. After 5 years or 3 years, you can acquire the balance. This is a good strategy when you are entering into a new industry, a new business, right? They practically think through these things. Any question on that? Yeah, this question is correct. Free cash flows, when you calculate free cash flows to equity, you have to deduct interest and those things. But here we calculating free cash flows to firm, right? And calculate the enterprise value and make the adjustment till equity. That's the strategy we use. That similar companies beta given as 0.4, whether it is asset or equity beta. One student asked the Viraj, Viraj, yeah. Viraj, they said their debt to equity is 30%. Then definitely their beta should be equity beta. Otherwise, we can't take it, no? Right? They clearly mentioned their debt to equity is 30%. Then the beta given, unless it's especially mentioned as asset beta, it should be equity beta. Right? Lasita, your question also okay, right? Here we calculate enterprise value, that value of the business we calculated. Then we reduce the asset value of the debt and the adjusted the cash flows. Lasita, are you okay? Your question? Right, then moving into next one. This question. WA Finance Control is of the view that the valuation of WA should not be carried out solely using discounted cash flow method, as it may result in a lower valuation and may not fully reflect the company growth potential. You know, in valuation type wise, where there are other valuation techniques also. Asset based valuation, you can take asset on book value, or you can take assets and liabilities on fair value, right? Net asset base you can take, or you can go for the market approach like price earning method, right? Using the price earning ratio, you can have the valuation of the business, or you can go for the dividend growth model. There are other methods as well. This finance controller believes that the other methods are better than discounted cash flow, because you can see once you discounted cash flows gives us the lower valuations, right? This view is supported by the observation that the fair value of property, plant and equipment and intangible asset have increased by 30 million and 10 million respectively. Further, finance controller has identified that additional provisions are required in respect of inventory and trade receivable 20 and 15 million respectively. Discuss the finance controller's perspective supported by appropriate explanation, alternative valuation approaches, and relevant calculations. Now, here what you have to do, you have to take other method of valuation and explain the meaning of these things, right? That is question number 4, right? Let's take Q4. I'm not going to write down one by one. That other methods are net asset base, right? Net asset base. You can write down net asset base. Then it has two methods. One is book value. You can take balance sheet net asset as it is, right? Book value. The presented net asset value in the recent financials. That is 296 million. That is directly given, right? Or you can take the second method, the book value. Second method is the fair value of net asset, right? It's clearly mentioned. You have 296 net asset in the books, right? Asset PPE and intangible asset is need to be increased by 10 and 30 million, right? PPE 30 million increase, you have to adjust it. 30 million increase, 30 million, then plus intangible asset 10 million increase, right? Then minus, you need to make a provision 20 and 15 for inventory and trade receivable, then 15 and 10, right? Yeah, 20 and 15. Then inventory, you have to reduce by 20 million, and receivables, you have to reduce by 15 million, I think. Yeah, 15 million. Then you can have a new valuation. That would be 296 plus 326, 336, right? 336, then 321, 301. That will be the new net asset value after make the revaluation adjustment. PP increased by 30 million, intangible asset increased by 10 million, inventory decreased by 20 million, and recoverables or receivables. Let's take receivables. Receivables. Is the 301 is correct? The calculation I'm asking. Lasita? Is that 301? I just calculated by mind. Okay. Right? This is the fair value of net asset. But you can't just calculate it and leave it. You have to write down the use of this net asset base. I will tell you write down, right? I'm not going to write it here. That is available in your study test. Net asset base is more suitable for a company which is difficult to estimate cash flows, right? This is more suitable, right? When difficult to estimate cash flows, right? Like uh, continuous loss-making entity, right? Or assets incentive business, You know, in Sri Lanka, real estate businesses only gives rental below 5%, right? You have invested in buildings, massive money you have invested in building, but rental gives only 5%. But investor focus not only rental, they are focused annually capital appreciation also. But if you go with the cash flow based approach, you have to take only the rent income. Then it gives a lower valuation for the asset. But at the market, it has a higher valuation for the building. That's why capital incentive business, you have a lot of capital investments there, but gives low real cash flows. Then you can, based on discounted cash flow method, you have to go for the net asset base. Or loss making companies, you can't estimate future cash flows, but you see some business is there. Then you can use net asset base. Those explanations you have to give, right? Then price earning method, you can put this, that price earning method is a market approach, right? Price earning ratio you will take from the market. Now you can calculate earning per share for this business, then take the price earning ratio from the market, right? And calculate the market price per share. But the problem is you have to take the price earning ratio from the market for similar company who listed or industry average. Most probably you are getting the price earning ratio of the similar listed company or average of listed companies in the same industry. The problem is in the market data depends on the minority shareholders action. If I give you some example, Lanka Hospital, uh, 5%, I think 5% is the stakes having in the public, right? 5% is the stake having in the public. All these transactions within these 5% shareholders create the market price of the entire hospital. That is not reasonable. Price earning, everything depends on these market approaches. This market approach not give you the real gravity of the business, because percentage wise it is very small having in the public. Those are the things you have to understand and write it down in the price earning approach. And mainly, you take a similar company PE or average of the listed companies PE in the industry. That is not exactly applicable for the selected WA pharmacy. Those are the issues if you are going to use it. Then other model is that one is PE method, right? Other one is dividend model. You know, dividend model always use when the investor only expect dividend, right? If you are an investor of the commercial bank or Sampath Bank or HNB or John Keys, the investors always expect dividend, right? Their decision rule is dividend. They made the investment based on dividend plus capital appreciation, right? Therefore, you have to say whether company continuously paid dividend, whether they have planned to pay dividend, whether investor only seek the dividend. In that situation, you can apply dividend model, otherwise it is useless. Now, what you need to do, that finance controller says these three methods are more suitable than discounted cash flow method. But you have to prove that these methods are useful in these circumstances. That should be the answer. Right? Now you can ask any question you have on this. On the chat, you can put. Any question, please type on the chat. මේ එක්සෙල් ෂීට් එකයි ඉතුරු ප්‍රශ්න දෙකේ උත්තරත් පුතේ දැන් එක්සෙල් ෂීට් එකේ ප්‍රශ්නයි සොරි එක්සෙල් ෂීට් එක දැන් මම හදපු එකයි ඒක මේ දැන් මේ කතා කර හදදි සමහර typing mistakes තියෙන්න පුළුවන් පුතා හරිද there can be some typing issues please redo the question today right this is a special question prepared by myself for this paper therefore I urge you to go through this question again while I'm typing on the Excel, there can be some formula issues, some typo errors. Please correct it and do the question again. What I wanted to give you the technique, the theory behind this, rationale behind this of valuation, right? Therefore, my request, redo this question tonight itself, right? That is my request. Now, sir, in pre-scene, which shall we select the optimist PE ratio? That is pre-seen in 2025 December. We are talking about the mock paper, right? PE, you take the market average if examiner gives you. Or if examiner gives you a similar company PE, take similar company PE. Otherwise, they will give you the market average, then take the market average. If both given, take the similar company PE. I think it's better, right? Or calculate for the both. If both available, calculate for the both, right? Okay, now the final questions. There is a ratio analysis question in the third question I have included. This is ratio analysis. Analyze the financial performance of Kandy Hospital taking into consideration the prevailing economic condition of the country and dynamic of the healthcare industry, right? Also, I have included the answer. Don't worry. This is the answer, right? One by one, I have analysis and put the answer here. I don't know whether examiner going to test the same thing, but I wanted to include this, right? Overall revenue, this much profit for the year, profit before tax, total assets, equity have been put there. Then profitability B has been analyzed, gross profit 544, gross profit margin 56, right? This is a strong gross margin by healthcare standards and indicate effective pricing, ability to pass the cost to the customer. These things they have, that's why they have huge gross profit margin. Then however, they have lower net profit margin, that is 3.5. You can see I have calculated operating profit margin 8.2, net profit margin 3.24. That means from 56% to 3.4%. Huge operational expenses they have incurred. That's the problem in this business. They have huge operational risk, right? Those things I have write down. What you have to write down also you can see here, right? Then that is profitable. Then cost structure, right? Cost of service 44% of revenue. Reasonable for hospital with high dependency on imported pharmaceutical and consumables. Skilled medical staff cost indicate decent control over direct material cost. Overhead and administration, again, they have huge overhead and administration expenses. I have explained what the reasons for these things, right? Then liquidity and working capital position also calculated. That current ratio calculated. Cash position calculated here, right? And highlights also given, right? Then capital structure has been calculated, equity ratio, right? Leverage also calculated, asset utilization calculated, and that what you can explain on that also I have included. I don't want to read these similar small things here. Answer is there, don't worry. Then impact of Sri Lankan economic environment, right? Healthcare dependent in non-discretionary and relatively recession resistant. Private healthcare demand has increased due to capacity constraint, rising middle income and insured patients, right? Challenges, high interest rate, currency volatility because it affects to the material or medicine imports, wage inflation, salary increasing highly, regulatory and scrutiny on pricing. There are a lot of pricing controls in the country for medicines, but it's not working. But always we can hear at the TV and radios, right? The hospital's ability to remain profitable in the context indicate operational resilience, but margin leave limited room for error, right? Then overall assessments also given here. Just read this thing and understand. If examiner asks you to do this, you can do the same thing. And the conclusion also given.